All right. So this analysis will be useful for investors, right? That which is called the earnings per share. So what is earnings per share and what is share? All right. I want you to imagine a company, any company, even the company that you analyze for your final assignment, the company that you chose. A share of that company means a piece of that company. It's like a piece of pizza. One pizza you can cut into how many slices? Okay, maybe one pizza you can cut into 10 sizes, 10 slices. So one slice of the pizza meaning one share. Okay, so a company is like a piece of pizza that you cut. Anyone who own the company is like owning the pizza, and anyone who own the company get what? Get a share of the profit, get the share of the earnings. So every company who is in business, the main goal is to make earnings as high as possible. No company start without looking to make earnings. Every company want earnings. So if you invest in the company, you only hope for one thing, earnings. All right. So this formula is helping you to understand and to find what is the earnings per share for your company. So the higher the earnings per share means for every piece of the company that you have, it makes a higher earning. All right, and this one relates only to ordinary share. So a lot of companies, they have many different kind of share, but others are not important. The most important is ordinary share. That means you are the actual owner of the piece of share. All right. So how do you find earnings per share? It's very straightforward. You take net income. If you don't look at the long formula, the standard, the basic formula is net income divided by number of shares. Okay, net income divided by number of shares. Let me draw. Net income divided by number of shares. Whatever that is left, preferred share dividend only if there is, and then the weighted average number of ordinary share. The word weighted average, I will show you why. But weighted average means the average number of share. Okay, why average? Okay, because the number of shares in the company can change from time to time. That means again, a company is like a pizza, huh? So they cut the pizza, see which one you buy, how many slices you buy. So at the beginning of the year, the same pizza, maybe they cut into 10 slices. And then at the middle of the year, the pizza, the same pizza, they cut into 5 slices, 5 slices. Okay. And then at the end of the year, they cut into 8 slices. So if at the beginning of the year you have 2 slices, 2 out of the total 10, let's say 2 out of 10, and then middle of the year, they only cut into 5. But pizza is still the same. So your 2 is actually 1. Okay? Your 2 slice is actually 1 slice because 2 out of 10 is actually 1 out of 5. So the size of pizza will always be the same. Not necessarily will be always be the same. It can be the same, but the number of share depending on how many times you cut the pizza. Okay, if I cut like that, how many slices we have? 1, 2, 3, 4, 5, 6, 7, 8. So if you have one piece of the pizza, you are having 1/8 share. So if the company make 8 million profit, if the company make 8 million profit, how much do you get? You get 1 million because 1/8 ma. Okay, your share is 1/8. So if the company total earning is 8 million, then you have 1/8. Okay, so what do you see and how do you calculate this? So if the pizza is 8 slices, your company got 8 shares and you own 1. So the earnings per share, how do you calculate? If the company earn 8 million, the number of shares is 8. So 1 share, 1 earnings per share is 1 million. Very straightforward. This is very easy lah, but in real life, a company don't just own 8 shares. They can own thousands and millions of shares. So whatever you earn, maybe 1 million, 2 million, or millions, you have to divide by the number of shares. Alright, so this is the formula. So for this page, we will understand a little more about what it means by weighted average ordinary shares. Alright. So you see, there is 3 compartments, 3 different time in the month. January to June, July to September, and October to December. So January to June is 6 months. So out of 6 months in a year, this company has 10,000 shares outstanding. Alright. And July to September, these 3 months, they have 12,000 shares. They cut into 12,000 slices. And from October to December, they have 15,000 slices of pizza. So you want to find the average number of share in the year. So you have to, you find how many months in the year times with the number of shares at that time. So this is how you find the weighted average ordinary share. And this weighted average ordinary share, you put it underneath at the bottom. And then the next info you need is the net income. So you just take net income divided by the weighted average ordinary shares. Okay. So earnings per share is very simple if the capital structure is simple. So what is capital structure? Capital structure is when your company capital. Where is the money coming from? So when you start a business, you start a company, this company can get money from many ways. One is through liability, one is through owner's equity. So if all your money comes from owner's equity, it's easy. Okay, that means all your money comes by selling your pizza to other people, selling your company to other people. So you only need to pay back the owner of the pizza, owner of your company. But in some cases, some companies is a little bit more complicated in their capital structure. That means they don't just sell their pizza to earn money, to get money. They borrow from the bank. They sell debt. They sell bonds. All this in order to get more money. So what it means is, yes, some people own the pizza, but before they can benefit from the pizza that they buy, before they can eat the pizza, they have to pay other people first. Where, example, who they borrow money from. They borrow money from Maybank. So once they make profit, before they can eat the pizza, they have to give some to Maybank first. Why? Because they owe them money. So you have to give to Maybank. Then only the remaining one is allowed for the owner of the share. Okay. So the next formula to find is the P, price over earnings ratio. In short form, we call it the PE ratio. I'll write that down. PE ratio. Okay. So what is the meaning of PE ratio? PE ratio is the price over earnings per share. So previously you know how to calculate earnings per share, how much earning that each share gets. But the next formula is to find what is the ratio compared to the market price. That means what is the price of the pizza now? One piece, not whole pizza, one piece. What is the price of one pizza? Divide by what is the earnings you get from every pizza. Alright? So you know what? You buy one pizza, you will get earnings. The more pizza you get, the more earnings you get. If the company make high income. But how do you get this pizza? You need to buy, right? So what is the price of this pizza? This pizza would be a market price. Who determined the market price? No one set the market price. You or the market, everyone else set the market price. Alright? For example, you go to Secret Recipe. You go to Secret Recipe. Secret Recipe, you can buy cake, right? So you go in and you see, oh, I like this cheesecake. But this cheesecake is how much? One big cheesecake. How much? I don't know. 100 plus? 100 plus. Okay. 150. Let's say 150 ringgit. 150 ringgit, they cut into 10 slices. So you can buy the whole cake, 150 ringgit, or you can buy one slice. Maybe one slice is 15 ringgit, 1.5. So if you buy one, you pay 15 ringgit. But what if nobody buy? Say, yeah, 15 ringgit for one slice of cake too expensive. If nobody buy, what they have to do? They have to reduce the price. Alright, so they reduce the price until a certain price where people will buy. So that will be the market price. So the market price divided by the earnings for every piece that you own is the PE ratio. So PE ratio, of course, there is price divided by earnings. So if company A and company B, they calculate the PE ratio. Okay, A got PE ratio of 5, B got PE ratio of 10. So based on your understanding, do you prefer A or B?
B.
B, why? Why B? Anyone else? No, no one. A is 5, B is 10. Let me write that down. A is 10, A is 5, B is 10, PE ratio. So what it means is, for example, how A get 5, how B get 10. Maybe A is 5 divided by 1. The other B is 10 divided by 1. So for $1 of earning, you pay $5. For $1 of earning, you pay $10. So if you want the same earning but you pay the less amount of money, of course you go for A, right? For example, can you give me what is the most value and cheapest phone in the market right now? Handphone. What is the most value, cheap, and most function phone in the market right now? One example. Hello.
Huawei.
Huawei. Okay. Good. So Huawei and another phone called A. Okay, I don't want to say what phone. Okay, for the Huawei phone, you pay $1,000. Okay, 1,000. You get all the top function, all the best function. 4 cameras lah, 5G LED Retina display lah, all those high tech function. Okay, you pay $1,000 to Huawei. There's another company called A. For everything, the same function, you pay $2,000. Same only, same with Huawei, but you pay $2,000. So what do you think A is?
More expensive.
Yeah, but what is the what example of the company you think is A? What brand? More expensive but all same function. What do you think is A?
Apple, iPhone.
iPhone same function with Huawei, everything same, but double the price. Oh. Then you think yeah, people stupid buy, pay so much for the same thing. But so this is the market price. Okay, on the top here, market price. One is 1,000, the other is 2,000. Okay, and what is the basic earnings per share? Earnings per share is what is your gain, your benefit. So Huawei got 10 function. Apple also got same 10 special function. So if you take this to calculate one example like this, so what is the PE for H? 100, right? And this one is 200, right? So which one is better, you think? When you look at the PE, I said H is 100, A is 200. So which one do you think is better?
H.
H, because you are paying a lower price, but you get the same function. But are you saying that A is not good, Apple is not good, because they have high PE ratio? Why Are they so expensive, but people still buy? Why? If you say PE ratio is low, is good, ma. How come PE ratio high, people still buy? So, if we based on PE ratio, do we go for low or high? So, PE ratio cannot help you to decide this. The only difference between this PE ratio between H and A, that certain people go for H due to low PE ratio because they want value for money. I pay low price, but I get high return, high benefit. That is why low PE. But what about people who go for high PE, people who go for A, Apple? They pay high price, but they get the same function. But maybe the function is more stable. Maybe lah. So that is why they are willing to pay more. Or maybe they think that A will have more updates in the future. More updates, more growth. So that when you pay 2,000 now, over 5 years, over 10 years, you will get more benefit. So that is the reason people go for high PE, and that is also another reason why people go for low PE. People who go for low PE, they look for high value. People who go for high PE, they look for high growth. All right? I hope it's clear. So, why do people find PE? Why is it important? Because it can be used to compare with industry competitor, like what I did just now. We compare two phones. But phone is not a very good example because P and E means price over earnings. What I calculate for the phone, Apple and Huawei, is basically price on top, but at the bottom is function. It's not shares outstanding. So PE ratio is used to calculate companies' shares. So you have to take the price of the share divided by the earnings per share, okay, of each company. So here they say interpretation: high growth firm have higher PE. Okay. The next, how do you know whether this company got high growth or not? You say, yeah, high PE ma, so high growth lor. Right. The next thing that you can see whether this company got a high growth or not is based on this percentage of earnings retained. Okay. When company make profit, they will usually give out as dividend because this dividend will go to the owner and the owner can use it as an income to spend. So net income minus dividend divide by net income. Okay, so the net income, whatever I earn, I minus out whatever I pay out divided by total of what I earn. So the amount that I didn't pay out is the percentage of earnings return. I didn't pay. Means let's say the company or the business make 100 million for this year. Okay? But they only pay 5 million for dividend. That means they give back to the owner 5 million over 100 million. So what is the percentage of earnings retained? 100 minus 5 divided by 100 is 95%. Okay? So when the company retains so much, it means one thing. It means that the company is going to use this money to reinvest in the company. To reinvest. That means they have a lot of business and they need a lot of money. So they don't pay out all the money, but they use the money for future expansion. So this high amount of percentage of earnings retained will contribute to a higher growth. Higher growth. All right. So this high percentage they mentioned here is typically found in new companies and growing companies. There are some companies that are not new and not growing. For example, F&N, Nestle, Coca-Cola. All these companies are already very big. So they don't really grow that much. So usually every income that they earn every year, they will pay out most of it. Okay? Okay. Next. Dividend payout. So again, when the company make profit, I'll show you here. When the company make profit or income, they will have to decide two things. One is how much to retain, how much to keep in the company. And another decision is how much to give out as dividend. Okay, they have to make two very important decisions. How much to keep and how much to pay back to give to the owner. So the amount of dividend payout is based on the amount of dividend divided by net income. Very straightforward. So like what you see just now, retained percentage, percentage of earnings retained is 95%. Let's say 95%. So the remaining 5% is what? Is dividend payout lor. Very easy. So if they retain 95%, that is the retained amount percentage. The remaining 5% is for this dividend payout. So if this company pay out only 5% is considered low. So this low payout usually found in new firms or growing firms. Same as before. Okay. So the next is we call with the same information that we have, we find dividend yield. So what is the meaning of dividend yield? Okay, for example, for every piece of pizza that you buy, you get a free topping. Okay, so different companies that you can buy pizza, they give you different amount of topping. So for Pizza Hut, you buy, they give you one piece of cheese as a topping. Okay, and in Domino's Pizza, they give you one piece of cheese and also one piece of sausage. So you can see whatever they give you in extra in topping is like a dividend. It's a bonus for you. It's an earning for you. So the more that you get in terms of dividend, and the lower price you pay means you get a higher dividend yield. So dividend divide by market price, you get dividend yield. So of course, most people want as high dividend as possible. Okay, so that they get higher return. But low dividend yield doesn't mean that the company is bad, yeah. Sometimes low dividend is because the company don't give you topping now. They don't give you dividend because they are reinvesting. They retain a lot and they reinvest a lot. That's why your dividends will be low. But in the future, they hope that one day, for whatever they reinvest, one day it will come back and they give you a very big dividend. Okay? So they sacrifice your dividend now for your future. Okay, the next is book value per share. Book value per share is basically for one share, what is the book value? So what is book value? Book value here on top here is whatever on top. Shareholders equity minus preferred share equity. That means how much of shareholder equity is contributed into one share. So example, when you buy a pizza, how much is the actual cost of the pizza? So let's say you buy not pizza lah, you buy secret recipe cake, you buy one piece, 15 ringgit. That 15 ringgit is market price. But what about the cost of making this cake? What is the cost for one slice? The cost of one slice maybe they use good quality cheese, they use good quality cream, egg, everything good quality. So maybe the cost is higher. So maybe the cost is 10 ringgit. Okay, this 10 ringgit is the book value. 15 ringgit is the market value. So market value is what is the price market will pay. Book value is what is the historical cost or the cost of that thing. Okay. So in this slide, they tell you about a little bit more about dividend. So what is dividend and how should companies give out dividend? So dividend, they say, is earnings of the company, but it should be given out as a residual. That means every company who make a lot of profit shouldn't give all the money as dividend, shouldn't give back to the shareholder everything. They should only give income as dividend only after considering all available investment that can increase the value of the company. Right? Let's say company A make a lot of income, 100 million. But this 100 million, they have two choices. One is to pay all out as dividend. The second is to retain all. But if they retain all, the shareholder or the owner will be unhappy. Say, yeah, why? I buy your share, but now I got no dividend. So what the company must do is they should consider this 100 million income. They should consider in the market what I can invest. How can I expand the business? If they look, they see, oh, let's say iPhone, Apple company, they make 100 million. So what should they do with this 100 million? One, they can give all the money back to owner or investor. Or this 100 million, they can spend about 50 million, half of the amount, they can spend 50 million to develop the next iPhone 13. Okay, so what should they do? Should they give the money all back to the shareholder, to the owner, or should they keep the amount in order for research and development of their new iPhone, new product? Of course, they want to keep it to develop new product because only new product can generate more future income. So therefore, the advice or the guidance that most companies should follow is that 100 million earning, they have to minus off all their possible project. As if Apple, 100 million have to minus 50 million because that is the reinvestment, and the 50 million remaining, that one should be given out as dividend. That is why we have to consider our reinvestment first. Only we consider dividend. So that is why this page, this slide, they call it dividend as a residual. Residual means the balance, the remaining amount only should be given as dividend. Okay, but not everyone like high dividend because in the world that we live in, there is tax. So when companies make profit, they get taxed one time. And when they give this money back to owner, this is owner's profit. So the owner's income. So they get taxed the second time. So some investors, they don't really like dividends because dividends are too highly taxed. But however, clientele effect means that different shareholders want a different kind of dividend policy. Some people invest because they want dividend. Some people invest, they don't want dividend, they want the company to grow. Okay, when the company grow, the value of the company go up. Okay, taxation. So a lot of people see dividend as a conveyor of information. That means when company pay dividend, it will mean that the company is giving out positive information. That means this company is healthy, this company is making profit, that's why they can give dividend. But a company who usually pay dividend, suddenly because of MCO, they don't give dividend. So this is information to people that, oh, this company is not doing so well. Okay? So dividends can act as an information provider. And dividends can be given, and some companies do not want to give dividend. They promise a future dividend, but now they don't give. So what they say is that people prefer dividend today because it is certain, it is sure that you can get it. But when dividends are promised far into the future, it is a higher risk. Maybe you will not get it. Maybe they promise dividend, and one day the company go bankrupt, you don't get dividend at all. Okay, so they prefer near-term dividend. Next. So, basically the owner of a company, every company, they don't manage the company. They only provide money. Who manage? The CEO, the manager of the company. When managers manage a company, they might do something that will benefit them, but will not benefit the company. So they will be selfish. Therefore, owner of the company who cannot monitor what the managers are doing, this owner, they will prefer to have high dividend. Because when they have high dividend, then this manager, they have to meet the KPI. They have to meet the mission. What is the mission? The mission is high dividend. So high dividend means what? The company must make high income, high profit. So it constantly push the manager to make high profit. And that way, if manager cannot make high profit, the owner got a reason to sack him. Okay, so owners can get better control if they request for a high dividend. If the owner is very relaxed, they say, no profit, never mind, no dividend, never mind. Then what will happen? Then manager will become lazy. They will say, my owner very good. He don't set a high KPI. Okay, when he don't set a high goal, high mission, it's easy to achieve. So I don't need to work hard. So this is the meaning of owner control through dividend. Okay, the next will be scrip dividend. When company are making money, but they don't want to give out this cash. as dividend. Instead, they instead of giving you more money, they cut more pizza, they create more pizza and give you pizza. They give you more shares. More shares means what? In the future, when the company make more money, you will get more dividend as well. So this is what is the meaning of scrip dividend. They give you dividend not in cash, but in shares, in stocks. Special dividend is when the company make a lot of profit, they announce a special dividend, like a bonus, paid in a one-off. Okay, the remaining few slides, I will continue after your break. Okay, shall we have a short break? Freshen up a bit. Oh, Aslan, I just saw your message. OnePlus. Yeah, I like OnePlus phone. Now it's about what? OnePlus 8 is out, right? OnePlus 8. But it's not cheap. OnePlus used to be cheap. OnePlus is expensive. Okay, for all those who are here, shall we go for a short break? 10 minutes?
Can.
Okay, shall we? Thank you. Okay, let's have a short break. We'll come back after 10 minutes and I will finish up and then you can discuss your tutorial. Okay, see you in 10 minutes. Hello, welcome back. Oh, you back?
Yes.
Okay. All right. Shall we finish up?
Yes.
Okay. If you can see our current slide, normal way is when company make profit, they will decide whether to give dividend or whether to retain the earnings. When they give out to dividends, means the owner will be happy and the value of the company will be high. And another way that if they do not give out dividends, the money that they retain, they keep in the company will be used for reinvestment. However, at certain times, they will have to come into a decision to provide not either of these, not any, but they come up with special dividends, or we call it as share repurchase. So what kind of special dividends and what is share repurchase? So share repurchase is when the company make a lot of money, so they buy back the shares from owners because the pizza is too big already, too many slices. So what they do is they buy back this pizza from people. So let's say you bought this pizza, one piece of pizza for $1 10 years ago. Now this company make a lot of money. Instead of giving you dividend, they offer. They say, hey, you bought our pizza 10 years ago, right? For $1, right? So now we have a lot of money. So instead of giving you dividends where you will be highly taxed and all those, why not I offer you to buy back this your pizza for $10. So 10 years ago $1 ma. Now they offer to buy back for $10. So when they buy back this share from the owner, that means the pizza will become smaller. That means now the pizza belong to the company itself. And this pizza that they bought back can be used for themselves. They keep so that they can eat it. Whatever dividend they can give it to themselves, or they can keep it to give to as a reward to good employees. They can do whatever they want, right, with this pizza. So when they buy back all this pizza, another good thing is that there will be less and less shareholder that own the company. All right. So this is share repurchase. So the two key question is, can shareholders' wealth be increased by changing dividend patterns, and is a stable dividend better than one that is changing from year to year depending on the company's need? Okay, there are here mentioned four forces that contributes to a dividend decision. So one is to encourage company to give a low dividend payout. Another one is to encourage companies to give a high dividend payout. Another two more is promote stable dividend, and another is to promote fluctuating dividend. Dividend based on the earning. So if earning is high, high dividend. Earning is low, low dividend. Another one, stable, means whatever the earning is, they will pay a stable dividend, $1 every year, stable. And another one is pay low. That means they can pay $1, but they don't pay $1. They pay 50 cents for dividend. Okay? Another one is to pay a high payout. That means when they can pay $1, they force them to pay $1.50. Okay, so what is the reason for owner to request for high payout? The main one that you can see here is owner control. When the owner demand for high dividend, that means they set a high and a difficult mission for the manager. So when manager, they have to make sure that the company make high profit in order to continue to pay high dividend. If they cannot pay high dividend, then the owner can use this excuse to remove him, to change manager. So they can control them. Some managers are very powerful, even owners cannot control. Okay, another reason for low dividend, why they encourage low dividend, so that companies that are unstable in earning, their earning is still not stable, they can still pay dividend low. And because if this company have a very high growth potential, they can retain a lot and reinvest a lot to fight competition. So then they encourage low dividend. Okay. Next one, stable dividend, so that when you can pay stable, that means they increase the credit rating. That means this company will be very powerful, very strong, because will look like they are very strong because they can pay stable dividend even the economy is bad, even the economy is good, they still continue to pay. They never cut or they never do anything. They can still pay stable. And another one is fluctuating dividend. That means dividend based on their earnings. When the earning is high, they pay higher. If the earning is low, they pay low. All right. So the best or the suggested one, okay, the suggested way to give dividend is to encourage low dividend payout, continuously low, so that the balance can be used for reinvestment. If there is no reinvestment, never mind. They continue to pay low until one day that they have too much earning. Okay, they have too much retained earnings and they have nothing to invest. And then that time they can pay out a special dividend here. Okay, continue to pay low dividend, and when they have too much earnings, they can pay a special dividend. Okay, this would be the suggested dividend policy. So in this chapter, we learn all about investors' return in the form of dividend. And for companies, dividend is like their obligation, because a company is like a working entity, is an item that works. So whatever they work, whatever profit they generate, should go back to the owner. So whatever profit they make is given back to the owner in the form of dividends. So that's why this topic, dividend, is very, very important thing for business owner, and companies as well. Okay. Any questions so far? Okay, if no question, we can prepare for your tutorial. I will leave the floor to you. You can take your time. Start, whoever start, you can start now. Okay, I give you 2 to 3 minutes lah to prepare and get yourself ready. Right? So you can start in 2 or 3 minutes. Okay.